Remember after the 2008 financial crisis? The world's biggest banks, well, they made a big promise. They told us they'd changed. They talked all about this new era, a better, more ethical culture. The big question is, did they actually keep that promise?
All right, so let's get right into it. This is really a tale of two worlds. You've got the public promise of reform, and then you have these allegations of what was really going on behind closed doors. First up, let's talk about that public promise. To really get what the banks say they're doing now, we've got to rewind the clock a bit, back to the ashes of the financial crisis.
So after everything went down, regulators and academics basically came to this huge realization. They figured, hey, preventing the next crisis isn't just about piling on more rules. It was about something deeper. It was about fundamentally changing the culture of banking. You know, those unwritten rules, the stuff that dictates how people actually behave when they think no one's watching.
And you know what? The biggest banks were all on board, publicly at least. Suddenly, their annual reports started sounding a whole lot like this one, just filled with talk about their new, improved, super customer-focused culture.
And this wasn't just a one-off. Nope. The messaging from pretty much every major bank was the same. It was all about rebuilding trust, putting the customer first. This really became the central pillar of their public image after the crisis. So, this new philosophy, it was built on three big ideas. First, ethics. Not just following the law, but the spirit of the law. Second, a strong internal culture to make sure everyone was on the same page. And third, this idea of a higher purpose, something bigger than just making a ton of money.
So that was the promise. And it sounds great, right? Super compelling. But what if it was all just window dressing? Because a huge class action lawsuit, this one filed by the New Mexico State Investment Council, well, it paints a completely different picture of what was supposedly happening behind the scenes.
Okay, to really understand what this lawsuit is all about, we have to talk about the financial product that's right at the center of it all. It's called a credit default swap, or CDS for short.
So what is a CDS? Well, the simplest way to think about it is like an insurance policy, but for a company's debt. If you buy a CDS, you're basically betting that a company will fail to pay its debts. And if you sell one, you're betting it won't. Pretty straightforward.
So what happens when a company actually defaults? That triggers something called a credit event. And when that happens, a special auction is held to figure out, okay, what are these defaulted bonds worth now? And here's the crazy part. The final price from that single auction determines the payout for billions of dollars in CDS contracts across the entire market. One price settles everything.
And right there, that auction process, that's the heart of the lawsuit. The allegation is that a small, very powerful group of the world's biggest banks got together and colluded to rig these auctions for their own benefit.
And when you look at the list of defendants, it's a who's who of global finance. The lawsuit claims they formed this so-called dealer working group, basically an inside club, to secretly control the entire settlement process. We're talking everything from the auction rules right down to the final price.
Okay, now look at this chart, because this is pretty much the smoking gun, according to the lawsuit. It shows the difference between the final auction price and the bond's actual market price. See the dark bars? Those are sell auctions, where a lower price helps the banks. And look, the price is consistently pushed down. Now look at the light bars, the buy auctions, where a higher price helps them. The price is consistently pushed up. Is that a coincidence? The lawsuit says absolutely not.
So the key takeaway here is that this wasn't just random market noise. The lawsuit alleges this was a coordinated, systematic effort. They claim it involved sharing information behind the scenes, manipulating bids, and all of it designed to rig the final price. And often, this came at the direct expense of their own clients.
All right, so let's put these two pieces side by side. On one hand, you have this grand public promise of a brand new culture. And on the other, you have these allegations of a secret inside club.
And just to give you some perspective on this, since the financial crisis, U.S. banks have paid, get this, over $243 billion in fines for all sorts of misconduct. Now, if you glance at the top of that list, you're going to see some familiar names. Yep, many of the very same banks named in the CDS lawsuit have already paid out tens of billions for other problems, all while they were publicly talking about their renewed commitment to culture. It really makes you wonder, right? Are these massive fines actually a punishment, or are they just seen as a routine cost of doing business?
The contrast here is just, wow, it's stark. In one corner, you've got all the talk about putting clients first and restoring trust,
And in the other corner, you've got these incredibly serious allegations of secret collusion and manipulating prices, which is the exact opposite of that.
You know, academic research actually breaks down banking culture into two main types. There's the safety-focused bank, all about control and managing risk, and then there's the growth-focused bank, more about competition and, making deals happen. The banks promised us they were the first kind, the safe one, the one that does right by the customer. But the behavior we're hearing about in this lawsuit, secret collusion for profit, which one does that sound more like?
And this really brings us to the biggest question of all, the real heart of this whole thing. After all the promises, after the billions in fines, after all the talk of reform, has anything really changed? And let's be super clear about this. This isn't just raking up some old dirt from before the crisis. No. The lawsuit alleges this stuff was happening right up through 2020. That's more than a decade after all those promises about a new culture were made.
The theory from the experts is pretty straightforward. A company's real purpose shakes its culture, and that culture, in turn, drives how its employees actually behave. You could almost say this lawsuit puts that entire theory on trial. It's asking, does the purpose they talk about match the purpose that's actually driving their behavior?
So, at the end of the day, we're left with this huge, nagging question. If the public promises don't line up with the private actions, and if hundreds of billions in fines are just shrugged off as the cost of doing business, then what does real accountability even look like? It's a tough one to answer.